The US dollar has lost over 85% of its purchasing power in that time frame. Real estate across the United States, the UK, and Germany has appreciated tenfold. The S&P 500 has compounded exponentially, creating trillions in paper wealth. Even gold, the ancient standard of value, has moved from $850 to over $2,000 an ounce. But there is one anomaly, one glitch in the financial matrix. Did you know that silver is the only major asset on the face of the earth that is priced lower today than it was in 1980? In January of 1980, silver hit $50 an ounce. Today, over 40 years later, it frequently struggles to hold the $30 mark. If you were to adjust that 1980 peak for inflation, using the government's own consumer price index numbers, silver should theoretically be trading at over $170 an ounce right now. If you use the real inflation metrics from the 1980s, before the calculation methods were changed to suppress volatility, the price should be closer to $600. This is not just a market inefficiency. This is likely the single biggest asset mispricing in modern history. And it is happening at the exact moment that humanity is becoming more dependent on this metal than at any point in technological civilization. We are standing on the edge of a precipice. By 2026, the mathematical reality of geological scarcity and industrial demand is going to collide with the artificial reality of the paper derivatives market. When that collision happens, the result won't just be a standard bull market. It will be a repricing event that fundamentally changes the financial lives of those who are paying attention. Most people look at the chart and see a volatile, frustrating metal. We look at the data and see a ticking time bomb. To understand why 2026 is the critical year, we have to stop thinking of silver merely as poor man's gold or a speculative trading vehicle. That is a 20th century mindset. In the 21st century, silver is not just money, it is a strategic technology metal. It is the invisible backbone of the modern world. Silver is the most reflective metal in existence. It is the best conductor of electricity known to man. Better than copper, better than gold. It is naturally antibacterial. It is thermally conductive. Why does this matter for the economy of 2026? Because the entire global economy is transitioning into a phase that is intensely hungry for these specific chemical properties. We are moving from the age of oil, where energy was burned, to the age of electricity, where energy is stored and transferred. You cannot build a digital society without silver. Every time you swipe your smartphone, you are touching silver. Every time you start a modern car, turn on a light switch, or see a solar panel on a neighbor's roof, you are looking at silver consumption. Here is the trend that Wall Street algorithms are drastically underestimating. The green transformation. Governments across the West, the United States, the United Kingdom, and the European Union have committed trillions of dollars to net zero targets and green infrastructure bills. They want to electrify the power grid. They want to replace internal combustion engines with electric vehicles. They want to replace coal plants with vast solar farms. They want to roll out 5G and eventually 6G networks to every corner of the globe. There is just one problem. The physics do not work without silver. Consider the automotive industry. A standard internal combustion car uses about 15 to 28 grams of silver for its electronics. But an electric vehicle, it uses up to 50 grams. As we move toward autonomous driving capabilities, the sensor suites, cameras, and computing power required will push that number even higher. The auto industry is shifting from a steel-heavy industry to a silver-intensive industry. But the real monster in the room, the factor that changes the equation for 2026, is solar energy. In 2023, the photovoltaic industry consumed roughly 190 million ounces of silver. That is nearly 20% of the entire annual supply coming out of the ground. But the technology is changing. The industry is moving toward new, more efficient solar cells known as TOPCon and HJT cells. These newer technologies require significantly more silver paste per unit than previous generations. Analysts project that by 2026, the solar industry alone could swallow 30 to 40% of global mining supply. Think about the implications of that. One single industry consuming nearly half the global supply. This leaves the electronics industry, the medical industry, the military, and the jewelry industry fighting over the scraps. This creates a scenario of inelastic demand. If the price of silver goes to $100, Apple cannot stop buying it for their iPhones. Tesla cannot stop buying it for their cars. They need it to finish the product. They will pay any price. The big picture is simple. The industrial world is burning through silver at a rate that is unsustainable, treating a precious metal like a common utility. By 2026, the stockpiles that have buffered this consumption will be gone, and the market will have to face reality. But for the American audience, this isn't just about global vague promises. It is about the law of the land. We have to talk about the Inflation Reduction Act, or the IRA, passed by the US Congress. Regardless of your politics, you must understand the financial mechanics of this bill. It is effectively the single largest green energy stimulus in American history. It allocates nearly $400 billion specifically to energy security and climate change programs. This legislation incentivizes the domestic production of solar panels and electric vehicles on US soil. It offers tax credits for homeowners to install solar. It forces auto manufacturers to source their battery metals from friendly nations to qualify for subsidies. This is a direct funnel of US Treasury money into the industrial silver market. Before the IRA, silver demand for solar was driven by China. Now the United States is reindustrializing its own energy grid. We are seeing massive solar factories breaking ground in Georgia, Arizona, and Texas. Every single one of those factories is a future buyer of silver paste. The US government has effectively mandated a silver squeeze by law without realizing it. They have written a check that the mining industry cannot cash. When demand goes up, standard economics teaches us that supply should increase to meet it. If the price of corn goes up, farmers plant more corn. If the price of oil skyrockets, drillers open more wells. But silver is different. And this is the strategic bottleneck that very few financial advisors understand. Silver is almost never found alone. In the 19th century, you had primary silver mines, holes in the ground where you pulled out mostly silver. Today, those are geological rarities. Roughly 72% of the world's silver comes as a byproduct of mining for other base metals, specifically lead, zinc, copper, and gold. This means that silver supply is inelastic to price. Let's say the price of silver doubles tomorrow. Does a massive copper miner in Chile produce more copper just to get the extra silver? No. The silver revenue is just a rounding error to them. They mine based on the demand for copper. If the global economy slows down into a recession and demand for lead and zinc drops, the supply of silver drops with it, even if silver prices are skyrocketing. We are also facing a crisis of ore grades. We have picked the low-hanging fruit. In 2005, the average primary silver mine yielded roughly 13 ounces of silver per ton of earth moved. Today, that yield has collapsed to under 6 ounces per ton. We are having to move twice as much earth, burn twice as much diesel, and use twice as much water to get half as much metal. This is an energy-intensive process. As global energy costs rise, the floor price for mining rises. Now look at the jurisdiction risk. Where does silver come from? The top producers are Mexico, China, and Peru. Mexico, often called the Saudi Arabia of silver, is becoming increasingly difficult for foreign miners. Political shifts, labor strikes, and security issues with cartels are choking supply. In 2023 and 2024, we saw major shutdowns in Mexican operations due to labor disputes. In Peru, social unrest frequently blocks the roads used to transport ore concentrates to the ports. Furthermore, the mining industry has been starved of capital. For the last decade, Wall Street has hated commodities. They poured money into tech stocks, software, and crypto, ignoring the old economy. As a result, exploration budgets were slashed. It takes 10 to 15 years to take a mine from discovery to production. This means the supply for 2026 is already determined. It is baked in the cake. We know exactly what is coming online, and it is not enough. For the last 3 consecutive years, the Silver Institute has reported massive structural deficits. We are consuming hundreds of millions of ounces more than we mine. We are filling the gap by draining above-ground vaults in London and New York. By 2026, the math suggests those vaults will approach critical lows. This is the definition of a supply squeeze. The industry is running on fumes. If the supply is falling and demand is rising, why hasn't the price exploded yet? Why is silver stuck in this frustrated trading range? To understand this, you have to look at the machinery of the pricing model. You have to look at the COMEX in New York and the LBMA in London. The price of silver is not discovered by 2 people exchanging physical metal. It is discovered by the trading of futures contracts. Paper promises to deliver silver at a later date. On the COMEX, the volume of paper silver traded daily often exceeds the entire annual global mining production. Think about that absurdity. In a single day, traders swap paper representing more silver than exists in the ground for a whole year. This system allows large institutional banks, often referred to as the bullion banks, to manage the price. They can flood the market with unlimited paper silver, short positions, to absorb buying pressure. This is often called tamping down the price. Why do they do this? There are many theories. Some say it is to protect the dollar. If precious metals rise too high, it signals a loss of confidence in the fiat currency. Others say it is simple profit-taking by market makers who front-run the hedge funds. But this manipulation has a fatal flaw. It relies on the illusion of delivery. The futures market works only as long as investors are happy to settle in cash or roll over their contracts. If investors stand for delivery, if they say, "I don't want cash, I want the metal," the system breaks. We are seeing signs that the smart money is starting to take delivery. Look at the registered category in the COMEX vaults. This is the silver available for immediate delivery to fulfill contracts. Since the silver squeeze movement began in 2021, the registered inventory has plummeted, dropping by nearly 70% at its lowest point. The ratio of paper ounces to physical ounces is stretching to a breaking point. Currently, for every ounce of physical silver in the vault, there are hundreds of paper claims trading against it. By 2026, we anticipate a decoupling event. This is when the paper price and the physical price separate. You might see the screen price at $35, but if you call a dealer to buy a 1,000-ounce bar, they will tell you the premium is 50%, making the real price over $50. When the paper market can no longer deliver physical metal, the exchanges will be forced to declare force majeure or settle in cash only. At that moment, the true price discovery begins. The suppression ends not because the regulators stop it, but because the physical market overwhelms the paper market. If you want proof that the US market is broken, you don't need to look at a complex chart. You just need to try to buy an American Silver Eagle from the US Mint. The Silver Eagle is the official bullion coin of the United States. By law, the US Mint is required to produce these coins to meet public demand. But for the last 3 years, they have failed. We have seen periods where the premiums, the extra cash you pay above the spot price, on Silver Eagles hit 70 or 80%. Think about that. The spot price says $25, but to get the coin in your hand, you have to pay $45. The US Mint has publicly blamed silver blank shortages. They claim they can't get the planchets, the round metal discs, to stamp the coins. Why? Because the blanks are made of pure silver, and the industrial buyers are bidding higher than the mint. This is the retail disconnect. In the United States, we are seeing a bifurcation. The paper price on Wall Street is set by algorithms trading contracts. The street price on Main Street is set by scarcity. By 2026, we predict this premium will become the new normal. The spot price might become a theoretical number that only exists for banks, while the street price for Americans trying to protect their savings will be completely detached. Now, let's go deeper. Let's look at what the mainstream financial news, CNBC, Bloomberg, The Wall Street Journal, often refuses to discuss in depth. The geopolitical and monetary dimension. For 50 years, the US dollar has been the undisputed king of global trade. But since the weaponization of the dollar following the sanctions on Russia in 2022, the world has changed. Nations like China, Russia, India, Brazil, and Saudi Arabia, the BRICS bloc, are actively looking for alternatives. They know that if they hold their reserves in US Treasury bonds, those assets can be frozen with the stroke of a pen if they disagree with American foreign policy. So what is the alternative to the dollar? It isn't the euro, it isn't the yen. It is hard assets, commodities, things that cannot be printed and cannot be frozen. Central banks have been buying gold at a record pace, but the populace in the East buys silver. India is the whale in the silver market. The Indian culture, unlike the West, understands that wealth is not a number in a bank account. Wealth is weight. In 2022 and 2024, India imported massive amounts of silver, effectively cleaning out the London vaults. They are converting their trade surpluses into physical metal. They are preparing for a world where fiat currencies are devalued competitively. This brings us to the fiscal dominance thesis for 2026. The United States national debt is compounding at a rate that is mathematically impossible to pay back in real terms. Interest payments on the debt have surpassed the defense budget. There are only two ways out for the US government: default, which is political suicide and would collapse the global banking system, or inflation, printing the money to pay the debt. History tells us they will choose inflation. They always do. By 2026, the Federal Reserve will likely be forced to lower interest rates or engage in yield curve control to keep the government solvent, regardless of what inflation is doing. When real interest rates turn negative, meaning inflation is higher than the interest you earn in the bank, capital flees to safety. It flees to assets that cannot be printed. Silver is the most accessible lifeboat. Gold is expensive. It is the asset of the elite and the central banks. Silver is the asset of the people. It is the populist inflation hedge. When the general public in the US and Europe finally realizes that inflation is not transitory but structural, the rush into silver will be frantic. But remember the size of the market. The silver market is tiny. All the investment-grade silver available in the world is worth less than the market cap of a single mid-sized tech company. If just half of 1% of global pension funds and institutional capital tries to move into silver, there isn't enough metal at $30, $50, or even $100 to satisfy them. The price will have to go vertical to balance the demand. So where does the price go? Let's look at the technicals and the ratios for 2026. First, consider the gold to silver ratio. This measures how many ounces of silver it takes to buy 1 ounce of gold. Historically, in the Earth's crust, the ratio is about 15 to 1. In the Roman Empire, the monetary ratio was 12 to 1. In the United States, prior to the 20th century, it was 16 to 1. Today, it fluctuates between 80 and 90 to 1. This implies that silver is massively undervalued relative to gold. It is the cheapest asset on the board. Historically, this ratio acts like a rubber band. When it gets too stretched, it snaps back. In 2011, it snapped back to 30 to 1. In 1980, it hit 17 to 1. If gold hits $3,000 by 2026, which many analysts believe is conservative given the sovereign debt situation, and the ratio merely returns to its 2011 level of 30 to 1, silver would be at $100 an ounce. If the ratio overcorrects to 15 to 1, as it often does in a true mania, we are looking at $200 silver. But let's be conservative. Let's look at the cup and handle formation on the long-term technical charts. This is a massive pattern spanning 44 years. The rim of the cup is the $50 level. We have tested this level twice, in 1980 and in 2011. Here is a cleaned, policy-safe, non-promissory version of your text. I removed or the handle portion of the long-term price structure has been forming for nearly a decade. From a technical perspective, once price moves above the $50 level, it enters an area with very limited historical trading activity. This means there is relatively little past price action to act as resistance. Our analysis suggests that over the next few years, silver may attempt another move toward that level. If momentum continues and broader market conditions support it, higher price zones, such as the low 70s or beyond, could come into focus based on long-term technical extensions and historical comparisons. One reason analysts watch the $70 region is that it aligns with key Fibonacci extension levels and represents an inflation-adjusted comparison to previous market peaks. These levels are often monitored closely by traders, though they are not guarantees of future performance. That said, it's important to understand the downside risks. Silver is not immune to market-wide sell-offs. In a deflationary or liquidity-driven crisis, similar to 2008, assets across the board can decline as investors sell what they can to raise cash. Silver, being highly liquid, can experience sharp short-term drops during these periods. Historically, however, periods of extreme monetary stress have often been followed by aggressive central bank intervention. In past cycles, such interventions have coincided with strong recoveries in hard assets. In 2020, for example, silver declined sharply before rebounding as liquidity returned to the system. Looking ahead, many analysts believe that policymakers will continue to prioritize financial stability. This has historically supported demand for real assets during periods of monetary expansion. Beyond macroeconomics, industrial demand plays a critical role in silver's long-term outlook. Modern technologies rely heavily on silver's conductive properties. Data centers, advanced electronics, and next-generation computing infrastructure require efficient thermal and electrical performance, areas where silver excels. As digital infrastructure expands, industrial consumption continues to grow. Defense and aerospace applications also rely heavily on silver-based components. Advanced communication systems, precision equipment, and aerospace technologies all depend on reliable conductive materials. These sectors tend to be less sensitive to economic cycles and are often supported by long-term government budgets. Another emerging factor is shifting investor behavior. Younger investors who grew up with digital assets understand volatility and scarcity. Many view tangible assets as a way to diversify beyond purely digital or paper-based systems. Silver, with its physical nature and historical role as money, often fits into that narrative. Unlike gold, silver tends to exhibit higher volatility, which can appeal to investors accustomed to fast-moving markets. Its dual role, both industrial and monetary, gives it a unique position among hard assets. As financial markets evolve, silver continues to sit at the intersection of technology, industry, and monetary psychology. While no outcome is guaranteed, its role in the global system remains significant, and that is what keeps it firmly on the radar of investors worldwide. For the last 10 years, silver investors have been battered. They have suffered through false breakouts and tamp downs. They have watched other assets soar while theirs stagnated. This has created a sentiment of despair. Ironically, this is exactly what you want to see at a market bottom. Bull markets are born on pessimism, grow on skepticism, mature on optimism, and die on euphoria. Right now, we are somewhere between pessimism and skepticism. The average person on the street does not own any silver. They own Apple stock, they own Bitcoin, they own real estate. They do not own the one asset that makes the modern world function. By 2026, as the headlines change, as stories about shortages and solar mandates and currency debasement hit the mainstream media, the psychology will shift to FOMO, fear of missing out. When the crowd tries to enter a market this small, the door is too narrow. Imagine a bathtub. The water level is the price. The faucet is mining supply, which is trickling. The drain is industrial use, which is wide open. Now imagine dumping a massive bucket of water, investor demand, into that tub. The water level doesn't just rise, it splashes over the sides. That is the silver market in 2026. The liquidity of the market is too low to handle a rush of capital. The only release valve is higher prices. We also need to address the elephant in the room regarding US banking manipulation, JP Morgan. For years, many silver investors were dismissed for questioning whether large financial institutions had an outsized influence on price movements in the silver market. Over time, official investigations confirmed that certain trading practices in precious metals markets did occur, leading to regulatory action and major financial penalties. These events changed how many people view market structure and transparency. This context matters as we look toward 2026. Regulatory bodies have acknowledged that market behavior in the past was not always aligned with fair price discovery. While reforms were introduced, financial incentives remain powerful, and market distortions can persist longer than expected. This dynamic has acted like a force holding prices below their natural equilibrium. The longer pressure builds, the more dramatic the eventual adjustment can become. As we move closer to 2026, the ability of large institutions to control pricing dynamics may weaken. Physical inventories are tightening, and when supply constraints meet rising demand, price discovery becomes unavoidable. So what happens if silver moves to $50, $75, or even $100? History suggests the path will not be smooth. Volatility is likely. Exchanges may raise margin requirements, and market rules could shift to manage rapid price movements. Public narratives may also shift, with increased scrutiny on investors and producers alike. At the same time, strategic interest in silver is growing. Mining companies, many of which are trading at historically low valuations, could become acquisition targets. Large industrial players may seek long-term supply security by investing directly in production. When that happens, silver transitions from being viewed as a speculative asset to a strategic resource. For long-term investors, the focus is not short-term trading but positioning. Understanding counterparty risk is essential. Paper claims rely on complex systems of trust, while physical ownership removes many layers of dependency. As we approach the latter half of the decade, broader economic trends point toward a renewed emphasis on tangible assets. Industrial demand, energy transition technologies, and monetary uncertainty are reshaping the role of real materials in the global economy. Silver sits at the intersection of these forces, both a monetary metal and an industrial necessity. The story ahead is not just about price charts, it's about structural change. Supply constraints, rising demand, and shifting financial priorities are redefining value. The question is not whether change is coming, it's who will be prepared when it arrives.